Howdy, Jacob here. Today we're looking at the Cigna Group, healthcare provider and services industry, 98 billion market cap, 120 billion enterprise value. I usually don't like to do insurance companies, but health insurance is a little bit different in my perspective than property and casualty. Obviously, things can go bad, but it's mostly on a smaller basis. Whereas when I look at some property and casualty companies, especially on the insurance side, they insure houses down in Florida, which, I mean, I'm an actuary, so I could calculate it, but I'm an actuary on the health side, and so my knowledge base to be able to project, how accurately priced they are is definitely not my expertise, and so health insurance is more so my expertise, and so I feel somewhat comfortable coming up with valuations for healthcare providers and services industry like Cigna. And so the growth of the revenue, something that I didn't know, the company was founded in 1792. So they've been around for quite some time now. And they've really been enjoying the revenue increases that come along with pharmacy and medical trend being much higher than inflation. With 35 million in revenue in 2014 up to 195 billion in 2023. There was a massive jump though in 2018 and 2019. So we'll see what that was due to, likely an acquisition. But premiums growth 6%, 9%, 4%, 5%, 11%, 10%. Again, no surprise you're seeing in numbers greater than inflation, as medical and pharmacy are both well above inflation. Dividends, they didn't really pay much of a dividend until recently, and now it's still not substantial in relation to the earnings per share. Let's hope it's the same on the dividend side or the free cash flow side. Share count has gone up over the last 10 years, but has gone down significantly over the last 4 years. Balance sheet has $7.8 billion cash, a lot of receivables, CapEx, a lot of plant and equipment, long-term debt, 28 billion, short-term debt at 2 billion. So they do have a little bit of net debt here. Let's look at what 28 billion is in relation to free cash flow. Very minor. Their production of free cash flow is about 8 billion, sorry. And so you're looking at a little over 3 years of free cash flow to pay down that long-term debt, which their free cash flow has been going up quite substantially over the last 10 years. Again, that huge jump in revenue that we saw is because of a $24 billion acquisition in 2018. So extremely substantial increase of revenue due to acquisition, and it looks like they went into debt to do so. And then they have been paying it down somewhat consistently, at least the 2 years following, and then not so much pay down the last couple of years, but again, not necessarily needing to, I guess, right now. So use of cash with a company this big is kind of all over the place. Obviously, you have some huge acquisitions, but then you have some nets, deacquisitions or devastations. They are reinvesting a bit back into themselves, which you can see through this investment line. They're buying back quite a bit of shares, and then their dividend of 1.6% pays out 1.5 billion, which is very, very inconsequential in relation to their $8+ billion of free cash flow. I think we're ready to make some assumptions here on the revenue growth side. I think that organically they can easily grow at 5%. I mean, the medical trend alone is not under 5% forecast year over year for the next couple of years, and this is a 7-year forecast. And if we're also including maybe 20% to reinvestment, to acquisition on the capital allocation side, I think I'd be pretty comfortable with a 7 on the revenue growth side. little bit above market average PE based on their growth as well as their stake in the health provider industry. Their margins aren't substantial though, so I don't want to give them too high of a premium there on the P and price to free cash flow. I think for margins, I'll feel pretty good with maybe 4 and 4.5 with share change of, they are buying back quite a bit of shares. So 1% of shares would be about 100 million or $1 billion, 1% of shares. So 2% is 2 billion. 3% is 3 billion. I mean, they can easily do that. Maybe I'm missing something here. Seeing what their historical PE and price to free cash flow are, because I feel like that's going to be the difference driver here. So kind of hovering around maybe 11-12% or 11-12 on the terminal, the PE price to free cash flow. Price to free cash flow is maybe a little bit lower. I know, again, insurance companies have different P and price free cash flow based on their balance sheet being different. Same with banks and such. So for me right here, actually, let's go down a bit to 13, which I still think is reasonable. And then the dividend, have they increased that? It's just kind of new, so I'll keep that as is. So looking fairly interesting right now. Price point says needs to drop 9% before we get the price we're looking for here. I mean, I don't know if I'm missing something. I feel like when it comes to this, again, I don't usually do insurance companies, so I have less of an understanding about how even a health insurance company could differ a bit. But to me, the probability of loss when they diversify their portfolio to thousands of employers, it's so much less risky than, like, again, a company that's insuring houses down in Florida by the coast or something. So to me, probably not too much longer till I try to do further research here. I think this is looking interesting to me right now. Again, I don't usually do insurance companies though, so this could be, a learning opportunity for me, and then hopefully we both learn something as I do a deeper dive and think about how this valuation differs than the average company. But I hope you enjoy the video and have a great rest of your day. Thank you.